and sent US government bond yields up. Both moves tend to put pressure on precious metals because gold and its peers don't pay interest, and because they're priced globally in dollars. When those two levers move together, the effect can be sudden, especially when a rally has already pulled in a lot of fast money. We'll start with gold because it set the tone. Gold is still the reference point for the whole complex, and when it turns sharply, it often drags the rest with it, even when the underlying industrial stories for silver, platinum, and palladium are different. According to Reuters, spot gold fell by about 4% in early Friday trade after reaching a record high on Thursday of around $5,594 82 cents an ounce. Reuters put gold at roughly $5,183 an ounce during the pullback. Other reporting described even larger peak-to-trough swings during the most volatile moments before prices steadied. The key point is that the move wasn't a gentle drift lower, it was a fast repricing with sharp intraday swings that told you liquidity was thinner and nerves were higher than they'd been during the climb. That's a very large move for gold in a short space of time. It's also a reminder that when the market becomes crowded and when positioning is heavily one way, the unwind can be sudden. In plain terms, if too many traders are on the same side of a trade, a change in the story can force them to exit together. That can turn a normal dip into a sharp drop. It can also create a feedback loop where falling prices trigger stop losses, and those stop losses add to selling, which pushes prices down again. The Financial Times described the move as a rally going into reverse. It reported gold falling by as much as 8% at one point before stabilizing at a smaller decline. It also pointed to a cooling of speculative froth, including actions in China that were aimed at abnormal trading. That matters because when a market is being driven partly by speculative flows, any signs that authorities are leaning against excessive activity can change behavior quickly, even if the underlying reasons people own gold haven't changed. The immediate catalyst, though, was the Federal Reserve story. This wasn't a slow shift in inflation data or a gradual change in central bank language. It was ascribed an immediate market reaction that included a firmer US dollar and a drop in gold. That combination is important. A stronger dollar can make dollar-priced commodities more expensive for buyers using other currencies. At the same time, higher bond yields increase the opportunity cost of holding assets like gold, which don't pay any income stream. When those forces hit at once, they can overpower other supports, including safe haven demand, at least for a time. On the currency and rate side, Bloomberg reported the US dollar rising by about 0.3% against major peers as markets digested the wash news. It also reported US Treasuries falling, meaning yields rose, led by the long end of the curve. Bloomberg said the 30-year yield rose by about 5 basis points in the immediate reaction. In day-to-day terms, that's a meaningful move because it tells you the market wasn't just reacting in equities or in headlines. It was repricing the cost of money over a long horizon. For viewers who don't track the bond market closely, here's why that matters. When bond yields rise, it means investors can earn more interest by holding government debt. That can reduce the appeal of holding gold, which is often held as a store of value rather than for income. And when the long end leads, it can signal a change in how markets view long-term inflation risk, long-term borrowing costs, or confidence in policy. In this case, the move was widely framed as a credibility repricing. It's also worth noting that higher yields can tighten financial conditions more broadly, and that can encourage investors to reduce exposure to trades that have been working simply to cut risk. Now to silver, which saw a more dramatic swing. Silver often behaves like a louder version of gold. It can rise faster in a rally, and it can fall faster in a reversal. That's partly because it's smaller and can be more volatile, and partly because it sits in the intersection of investment demand and industrial use, which can make sentiment swing quickly. MarketWatch describes silver briefly dropping below $100 an ounce after record highs, as the so-called dollar debasement trade was hit. That phrase refers to a popular narrative in which investors buy precious metals on the view that a currency will lose purchasing power over time. When the dollar strengthens and yields rise, the narrative can lose momentum quickly, at least in the short term. And when that narrative has been a big part of the rally, the reversal can be abrupt. Across the coverage, silver's decline was described as high beta. That means it tends to move more than gold in both directions. In this episode, that pattern held. Reports range from roughly 9% to around 13% down on the day, depending on the timing and the reference price. The important thing for understanding the tape is that silver didn't just follow gold lower. It amplified the move, which is typical when traders are reducing risk quickly and when liquidity is being tested. Barron's also highlighted the role of profit-taking after very large January gains, and it noted the focus on widely watched psychological levels, including $5,000 an ounce for gold and $100 an ounce for silver. Those levels don't change the underlying value of the metal, but they can influence behavior. They're often used as reference points for stop losses, margin decisions, and headline-driven trading. When a market breaks through at a level that many people have been watching, it can change the tone in minutes because it shifts what traders think is likely to happen next, even if the fundamentals haven't changed. Platinum also fell sharply, and again the move looked more like a volatility unwind than a slow reassessment of supply and demand. Platinum can be pulled around by industrial expectations, but in a day like this it can trade as part of the broader precious metals basket, especially when investors are de-risking. The Financial Times reported platinum down by around 10% during the reversal. In the last day's trading, platinum appeared to be pulled along by the same forces hitting gold and silver: a stronger dollar, higher yields, and a rush to reduce risk across crowded positions. When that kind of selling takes hold, it can be less about the specific metal and more about the need to cut exposure wherever it's easiest to do so. There was also a China angle. The Financial Times said the Shanghai Futures Exchange took steps that included suspending a number of accounts in an effort to curb abnormal trading. Measures like that can reduce speculative activity quickly, and when speculation has been supporting prices, removing it can amplify a downturn. It can also change the intraday rhythm of the market because fewer participants are willing or able to step in and buy dips aggressively. Palladium moved lower as well, although it drew less attention than silver and platinum. Palladium markets can be thinner, and that can make moves look sharper even when the underlying driver is the same macro story. In the cited market snapshots, palladium was described as falling in sympathy with the broader complex. The declines reported ranged from roughly 4% to around 7%. There wasn't a dominant palladium-specific supply headline in the reporting. The move seemed to be mainly macro-driven, and palladium's thinner liquidity can sometimes make day-to-day swings look larger. When investors are reducing exposure across a sector, the less liquid corners can sometimes gap more, simply because there are fewer bids when selling hits. So what changed in the story over the past day? It helps to be clear about what was new and what was already in the price. Firstly, the Federal Reserve narrative shifted. The nomination of Kevin Warsh was treated as a signal that the next phase of US monetary policy could be firmer, or at least more credibility-focused. That interpretation may or may not prove durable over time, but in the last day it was enough to move markets. It also mattered because it arrived at a moment when prices were already stretched, so it didn't take much to tip sentiment. Secondly, the US dollar rebounded. That matters mechanically for metals priced in dollars. It also matters psychologically because a weaker dollar has been part of the fuel for the earlier rally. When that fuel disappears, traders who were leaning on it can reassess quickly, and that can turn a pause into a reversal. Thirdly, US yields rose, led by longer-dated bonds. That raises the opportunity cost of holding non-yielding assets, and it can force leverage traders to reduce positions. When volatility rises, margin requirements can rise too. That can create forced selling, particularly in silver and the platinum group metals. Even traders who still like the longer-term story can be pushed to cut positions if the short-term price action becomes too violent. Fourthly, the market looked technically stretched. Several outlets described overbought conditions. That's a technical term, but the plain English meaning is simple. Prices had risen very quickly, and the market was vulnerable to a pullback even without fresh news. When fresh news did arrive, the pullback became a rout. In fast markets, the difference between a healthy correction and a disorderly sell-off can be the speed of the move and the degree to which traders are forced to react rather than choosing to. It's also worth noting what didn't dominate the tape today. Sometimes on a day of sharp moves, the most useful thing is to identify which familiar drivers didn't have the final say. Geopolitical risks remained present, but it didn't prevent the sell-off. The Guardian's live coverage pointed to oil prices being supported by Iran-related concerns, even as gold and silver tumbled from record highs. That's a useful cross-check. It suggests the main driver in this window wasn't a clean, broad-based flight to safety. Instead, it was a repricing of rates and the dollar, with investors reducing exposure to trades that had become crowded. In other words, the market behaved less like a pure safe haven bid and more like a leveraged positioning story meeting a sudden change in the macro narrative. Now let's set this in a wider context because the longer run picture matters even on a day like this. A single session can be dramatic, but it sits inside a broader trend, and that broader trend helps explain why prices were so high before the reversal began. Despite the sharp drop, gold remains elevated compared with recent history. Part of that longer-term support has come from official sector demand. Central bank buying has been a recurring theme in recent years, and it's often discussed as a stabilizing force because it can be less sensitive to short-term price swings than speculative flows. According to the World Gold Council, central banks bought 863 tonnes of gold in the year 2025. The council said that this was well above average for the period covering the years 2010 through 2021, which put it at 473 tonnes. It also said that in the final quarter of 2025, central bank buying totaled 230 tonnes, and that Poland was the largest buyer across the year at 102 tonnes. Those are large volumes in the context of official sector activity, and they help explain why dips have at times found support. Those figures don't explain today's move, but they do help explain why gold has been able to sustain higher levels over time, even as it experiences sharp corrections. They also help explain why some investors treat sharp sell-offs as part of the normal rhythm of a higher price market, rather than as proof that the longer-term story has ended. There's also the question of where prices have been on average, not just at the peaks. Record highs make headlines, but annual averages tell you where the market has actually spent much of its time, and that can be a better guide to how the baseline has shifted. The London Bullion Market Association, the LBMA, publishes annual average prices, and the average gold price for the year 2025 was $3,431.54 an ounce, compared with $2,386.20 in the year 2024. That's a substantial change in the average level, not just in the extremes. For silver, the LBMA reported an average of $40.03 an ounce in the year 2025, compared with $28.27 in 2024. Again, that points to a higher baseline, even before you consider the most recent surge and reversal. For platinum, the LBMA reported an average of $1,224.73 an ounce in the year 2025, compared with $955.73 in 2024. That matters because it shows that the complex wasn't starting from a low level. It was already operating at higher prices before the latest burst of volatility. And for palladium, the LBMA reported an average of $1,150.29 an ounce in the year 2025, compared with $983.62 in 2024. Even with palladium's own specific dynamics, the average level was higher year on year. Those figures underline a key point. Even after a violent day, the broader precious metals complex has been operating at a higher level than it did in the prior year. That can be driven by many factors, including inflation expectations, currency moves, investment flows, and industrial demand. But in the last day, the dominant impulse was macro repricing rather than a slow-moving fundamental story. When macro forces take over, correlations rise and different metals can start moving together more than usual. Let's also touch briefly on the macro backdrop outside the United States, because it feeds into currencies and into risk sentiment. Even when the immediate catalyst is American, global data can shape how investors think about relative growth and relative interest rates, and that can influence the dollar and bond markets. Eurostat published a flash estimate showing the Eurozone economy growing by 0.3% quarter-on-quarter in the final quarter of 2025. That's not a precious metals driver on its own, but it's part of the wider picture for the euro, for global growth expectations, and for how investors position across currencies. In a market that's already sensitive to currency moves, even modest shifts in growth expectations can matter at the margin. Now, to bring the day's market mechanics into clearer focus, it helps to separate three layers of influence. This is a useful way to describe what's happened without getting lost in the noise of every tick. The first layer is the headline catalyst. That was the nomination of Kevin Warsh as the next Federal Reserve Chair, and the immediate market judgment about what that could mean for policy credibility. The key here is not the nomination itself, but the way it was interpreted in real time by traders who had to decide whether to hold risk or to cut it. The second layer is the transmission channel. That was the US dollar moving higher and US yields rising, particularly at the long end. Those are the levers that tend to move gold and silver quickly. When the dollar rises, it changes the global price signal. When yields rise, it changes the relative appeal of holding a non-yielding asset. When both happen together, the pressure can be intense. The third layer is positioning and market structure. After a strong run, many traders were sitting on profits. Some were probably using leverage. When prices turned, selling fed on itself. That's when you see silver and platinum fall more than gold, because they can behave like higher octane versions of the same trade. It's also when intraday volatility becomes a story in its own right, because large swings can force risk managers to cut exposure regardless of their view. This is also where market regulation can matter at the margin. If an exchange tightens rules or suspends accounts, it can reduce the ability of some participants to keep adding to positions. In a rising market, that can cool a rally. In a falling market, it can remove a source of buying that might otherwise slow the decline. The report about steps taken in China fits into that category, not necessarily the main driver, but a factor that can change the pace of the move. So where does this leave us this evening in a structured way without trying to forecast what comes next? The aim here is to summarise what we know and to be clear about what the market is reacting to. First, gold. The metal has pulled back sharply from record highs. The move was driven by a stronger dollar, higher yields and profit-taking after an extreme rally. Even after the drop, gold remains at historically elevated levels, and the longer-term context includes strong official sector demand, as described by the World Gold Council. Today's action shows that even in a higher-priced environment, gold can still move quickly when the macro story shifts. Second, silver. Silver saw a more violent reversal, with reports of a drop into double digits in percentage terms at points during the session. The move fits silver's tendency to amplify gold swings, especially when positioning is crowded and volatility rises. It also shows how quickly a popular narrative trade can unwind when key supports, like a weaker dollar and lower yields, reverse. Thirdly, platinum and palladium both fell in sympathy with the broader complex. Platinum's decline was particularly steep in the reporting, consistent with a leveraged unwind. Palladium also moved lower, with no single metal-specific headline dominating the coverage. In both cases, the day looked less like a metal-by-metal fundamental story and more like a broad risk reduction move across the sector. Fourth, the macro drivers. The US dollar strengthened and US Treasury yields rose, led by longer-dated bonds. Those moves were widely linked to the Warsh nomination and a repricing of Federal Reserve credibility. That combination was enough to overwhelm background support from geopolitical risk, even with oil supported by Iran-related concerns. In short, the market's focus was on rates and the dollar, not on safety flows. Finally, what traders will be watching in the next session is straightforward, and it's about the same transmission channels that drove today's move. They'll be watching whether the US dollar remains firm and whether US yields continue to rise or to stabilise, particularly at the long end. They'll also be watching volatility and signs of further liquidation, especially in silver and the platinum group metals, where sharp swings can trigger additional risk reduction. And they'll be watching for any further signs that exchanges or regulators are trying to cool abnormal trading, because that can affect liquidity and the speed of price moves. To recap calmly, precious metals fell sharply over the past day as a momentum rally reversed. The dominant catalyst was the nomination of Kevin Warsh as the next Federal Reserve Chair, which markets treated as a credibility and hawkishness signal. That helped lift the US dollar and push US yields higher, raising the opportunity cost of holding non-yielding metals. Gold dropped hard but remained elevated in a longer-term sense. Silver and platinum fell more, consistent with a crowded trade unwinding. And whilst geopolitical risk remained in the background, the rates and currency repricing was the main force shaping prices in this window. The story of the day, in the end, was how quickly sentiment can turn when the dollar and yields move together. So you're up to date on what moved today, what mattered and why it mattered. That is all for this evening's Global Precious Metals update from Wessexmint News. Please follow or subscribe to the channel on whichever platform you're watching us, and the odd like and share would definitely give us a very tangible asset. Thank you so much for joining us both today and for all of the 50 updates I've now presented. But things are being shaken up here, so for now this particular format experiment is over. I do hope we talk again soon, but for the moment, from me, Robert Corran, and from all of us here, thanks again and goodbye.
Hey, I just found the Wessexmint and it's a game changer.
You can actually buy real gold and silver online.
It's simple, no jargon, and you can start investing for the price of a coffee.
They even teach you how it all works with their academy.
Honestly, I wish I started sooner.
Start small, learn and grow.
Check out the Wessexmint.com to start investing like I did.
Hello, welcome to this Global Precious Metals update from Wessexmint News. Today is Friday, the 30th of January 2026. I'm Robert Corran. Coming up, the close and overnight look ahead. I'll cover gold, silver, platinum and palladium. I'll examine what's happened over the day. I'll also set those moves in a wider and longer context. And I'll close with a structured assessment of where the market stands this evening and what traders will be watching for the next session. The precious metals story over the past day has been about speed and about reversal. What had looked like a momentum-driven surge, helped by a weaker US dollar and heightened geopolitical nerves, flipped into a sharp sell-off. The key trigger was a rapid change in expectations for US monetary policy and for the credibility of the Federal Reserve, after President Donald Trump moved to nominate Kevin Warsh as the next Fed Reserve chair. That nomination mattered because markets treated it as a signal. It was read as a shift towards a more orthodox, more inflation-focused approach at the top of the US central bank. And that in turn pushed the US dollar higher and sent US government bond yields up. Both moves tend to put pressure on precious metals because gold and its peers don't pay interest and because they're priced globally in dollars. When those two levers move together, the effect can be sudden, especially when a rally has already pulled in a lot of fast money. We'll start with gold because it set the tone. Gold is still the reference point for the whole complex, and when it turns sharply, it often drags the rest with it, even when the underlying industrial stories for silver, platinum, and palladium are different. According to Reuters, spot gold fell by about 4% in early Friday trade after reaching a record high on Thursday of around $5,594 82 cents an ounce. Reuters put gold at roughly $5,183 an ounce during the pullback. Other reporting described even larger peak-to-trough swings during the most volatile moments before prices steadied. The key point is that the move wasn't a gentle drift lower, it was a fast repricing with sharp intraday swings that told you liquidity was thinner and nerves were higher than they'd been during the climb. That's a very large move for gold in a short space of time. It's also a reminder that when the market becomes crowded and when positioning is heavily one way, the unwind can be sudden. In plain terms, if too many traders are on the same side of a trade, a change in the story can force them to exit together. That can turn a normal dip into a sharp drop. It can also create a feedback loop where falling prices trigger stop losses, and those stop losses add to selling, which pushes prices down again. The Financial Times described the move as a rally going into reverse. It reported gold falling by as much as 8% at one point before stabilizing at a smaller decline. It also pointed to a cooling of speculative froth, including actions in China that were aimed at abnormal trading. That matters because when a market is being driven partly by speculative